Welcome back to Algobot, the channel where we take apart automated trading strategies and study how they actually think. I'm your host at Algobot, and today we're examining an expert advisor for MetaTrader 5 called Asymmetric Capture Momentum. This one does not lean on moving averages or classic chart patterns. Instead, it studies the raw stream of price returns and asks one simple question: which side of the market is doing the heavy lifting? Over the next few minutes, you'll learn the idea behind its custom capture asymmetry gauge, how it decides to enter and exit, and how it manages risk. Let's get into it. So what exactly is asymmetric capture momentum, and who is it built for? At its core, this expert advisor is a momentum continuation strategy, but it arrives at momentum in an unusual way. Most tools look at net price change, or at how many bars closed up versus down. This strategy ignores the tally entirely. Instead, it looks at the average size of each up move and each down move, and it asks which side is doing more work per step. The thinking is that in a genuinely directional market, the side in control tends to advance price in larger steps, while the opposing side only nibbles it back in smaller ones. So a big difference in the average step size, rather than the raw count, is treated as the cleaner sign of who owns the move. That difference is packaged into a single number called capture asymmetry, which lives in the panel below the chart and ranges from -1 to +1. The indicator driving the whole system, then, is this custom capture asymmetry gauge. It is not a moving average, not a standard oscillator, and not a chart pattern. It is calculated purely from the stream of bar-to-bar returns. On top of that sits a self-adapting threshold that responds to how noisy the signal has recently been. In terms of market, the EA is written to run on a single symbol and a single time frame, and it holds at most one position at a time. That makes it suited to a trader who is comfortable with systematic, rules-based approaches and who wants to study how a purely statistical view of price can be turned into entries and exits. As always, this is presented for learning and analysis. It is one way of framing the market, and like every approach, it carries real risk and will produce losing trades as well as winning ones. Let's break down the mechanics step by step. The strategy works on a single symbol and a single time frame, and it only acts once per completed bar, so it ignores the noise inside a forming candle. Each time a bar closes, the strategy records its closing price and calculates the relative return, that is, the percentage change from the previous close. From those returns, it builds its core measurement. Over a look-back window, 30 bars by default, it separates the returns into two groups, the positive ones and the negative ones. Then, and this is the key idea, it does not count how many are in each group. Instead, it measures the average size of each group. It calls the average up step G+ and the average down step G-. The capture asymmetry, labeled A, is simply the difference between the two divided by their sum. That keeps it neatly bounded between -1 and +1. When up steps are much larger on average, A leans positive. When down steps are larger, A leans negative. When they are similar, A sits near 0. Next comes the adaptive threshold. Rather than using one fixed level, the strategy calculates the standard deviation of its own recent asymmetry readings and multiplies it by the ThresholdK input, which defaults to 1. The result is clamped into a sensible band. The effect is that the strategy demands more asymmetry before acting when its own signal has been erratic and accepts less when the signal has been steady. Now the entry. A long signal is registered when the asymmetry line makes a fresh crossing from at or below the positive threshold to above it, and the most recent return is also positive. That second part is the release confirmation. The latest bar must agree with the signal's direction. A short signal is the exact mirror. A fresh crossing below the negative threshold, confirmed by a negative most recent return. Position handling is simple. If a new signal points against an open position, the strategy closes that position first and then opens a new one in the fresh direction. If it is already flat, it just enters. Finally, risk. When a trade opens, the stop loss is placed a multiple of the average true range away from entry, set by StopAtrMult, which defaults to 2. The take profit is that stop distance multiplied by the reward ratio, defaulting to 1.5, so the target sits farther away than the stop. Both levels are fully dynamic, adjusting to current volatility on every trade. Here's the heart of the strategy as it appears in MetaEditor. At the top are the input parameters you can adjust in the strategy tester. Windows sets how many returns feed the asymmetry calculation, 30 by default. ThresholdK scales the adaptive threshold. ATR period controls the average true range length used for risk. StopAtrMult and TpRewardRatio shape the stop distance and the reward target. And lot sets the fixed position size. Below that is the signal block. First, the code reads the adaptive threshold into the variable THR, and it reads the most recent return into last R. Then it checks two conditions. For a long, it asks whether the previous asymmetry value was at or below the threshold while the current value has risen above it. That is the fresh crossing, and whether the latest return is positive. If both are true, the signal is set to +1. The cell condition directly below is the mirror image. The previous value at or above the negative threshold, the current value below it, and a negative latest return set the signal to -1. Now look at the order placement. For a buy, the code takes the ask price, sets the stop loss or risk distance below it, and the take profit or reward distance above it, then calls trade.buy with the lot size, stop, and target. For a sell, it takes the bid price, places the stop or risk distance above, the take profit or reward distance below, and calls trade.sell. Notice how the risk value is the average true range multiplied by StopAtrMult, and the reward is that risk multiplied by the reward ratio. That is where the asymmetric, larger than the stop target comes from. The two sides are perfect mirrors of each other. Let's walk through an illustration of how asymmetric capture momentum reads the market. On top you can see a candlestick sequence, and in the panel below sits the strategy's own indicator, the capture asymmetry line. It ranges from -1 to +1. A reading near +1 would mean up steps completely outsized down steps. -1 means down steps dominate, and 0 means the two sides are evenly matched. The dashed bands mark the adaptive threshold, drawn here near plus and -0.3. Remember, in the live code that band is not fixed. It widens when the signal is noisy and narrows when it is calm. Look at the first three candles. Price drifts sideways to slightly lower, and notice the asymmetry line hovers just below 0, inside the neutral band. The up steps and down steps are roughly the same size, so the indicator finds no edge, and the strategy simply waits. This is exactly the chop condition the model is designed to sit out. Now watch the third and fourth candles. Price turns higher, and the up candles grow noticeably taller than the recent down candles. On the panel, the asymmetry line climbs. As the fourth candle closes, the line pushes up through the upper threshold band for the first time, and the most recent return is positive. That combination, a fresh crossing above the band plus a same direction confirmation, is precisely what the strategy waits for. You can see the buy entry marker appear on that candle. The interpretation is straightforward. Buyers are now advancing price in larger steps than sellers are giving back. So the strategy joins the move in the direction it is already traveling. The moment the position opens, two levels are set behind the scenes. The stop loss sits a set multiple of the average true range below the entry, and the take profit sits farther away, scaled by the reward ratio of 1.5. Because that ratio is above 1, the target is placed farther from entry than the stop. Follow the fifth, sixth, and seventh candles. Price keeps stepping higher, each close above the last, while the asymmetry line stays comfortably in positive territory. This is the continuation the strategy was counting on. On the seventh candle, price reaches the take profit target, and the long position closes for a gain in this illustration. Notice we never spoke a specific price there, because the entry and the target are structural levels on the chart, not printed numbers. Now the character of the market changes. On the eighth candle, a tall down candle appears, and the asymmetry line rolls over. Sellers are starting to take larger steps. Through the ninth candle, the line falls back toward 0 and then keeps dropping. The down steps are now clearly outsizing the up steps. Watch the 10th candle. The asymmetry line pushes down through the lower threshold band, and the most recent return is negative. That is the mirror image of the long condition, a fresh crossing below the negative band, confirmed by a down close. The sell entry marker appears. Had a long still been open, the strategy would first close it and then open the short. That is the flip behavior written into the code. For the short, the levels mirror the long. The stop sits a multiple of the average true range above the entry, and the take profit sits below, again scaled by the reward ratio. Across the 11th and 12th candles, price steps lower in the direction of the signal, and on the final candle it reaches the downside take profit target, closing the short for a gain in this example. So in one clean sequence you've seen both sides. A continuation long when up steps dominated, and a continuation short when down steps took over. And that brings us to the end of our look at asymmetric capture momentum. Today we explored its central idea, measuring which side of the market is advancing price in larger steps. And we walked through its adaptive threshold, its confirmed entry conditions, its flip behavior, and its volatility scaled stop and target. Remember, everything in this video is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. All trading involves risk, and losses do occur, so always do your own research and consider your own circumstances. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to study next, and subscribe so you don't miss what's coming. You can find more strategy analyses at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.